Welcome to the Texas Oil and Gas Podcast, the show dedicated to bring you the news from the oil patch deep in the heart of Texas, with your host, Ryan Ray and Josh Shelton. Welcome to the Texas Oil and Gas Podcast, and we're going to have to change our intro music if Josh Shelton keeps ducking the show. I am here, as always, I am the Brett Favre podcast, as you faithful listeners know. Today I have on a good friend of mine, a man that some of you know, some of you might not know. We have Morning Off the Rails we do together and Don't Want the Facts. He also hosts Coffee and Liquidity. I'm talking about the president, the CEO, the Oracle of Midland himself, Ben Samuels.
You know, always with the intros, Ryan, spot on. I appreciate that. I appreciate you calling out to the bullpen here. Hopefully I can hold up the seat here for Josh, and hopefully he's back to the ring tomorrow.
Low bar. By showing up, you've already accomplished that goal. It's really not that hard. So congratulations on beating Josh by showing up. Okay, so Ben, for those of you, I don't think you've been on the show before, have you?
No, sir.
Okay, so maybe introduce yourself for folks who aren't familiar with who you are. And all aside, Ben does a lot of stuff out in the Permian, so go ahead and talk about your business stuff as well.
I appreciate it. Been out in Permian, out in Midland for about 7 years now. Focused mostly on transactional A&D across the energy space, from equipment auctions all the way through minerals and surface and water disposition and development, and then own and operate a couple thousand acres of surface up in northeastern Martin County out here in the Permian, and looking out at building out some water programs and some oil field waste disposal processes as well. And then, like you mentioned, I have a number of podcasts, and somehow you keep me busy with the media stuff. Somehow you've coaxed me into the apprenticeship of the talking head. So I'm leaning into that a little bit, and that's been good as well. Although, like we've talked a little bit off air, that writing, I mean, that's a tough cookie to crack.
That is a tough cookie. I sat down last night to write a piece about the response to the portal from hell in the Gulf of Mexico. And I got like 3 words in. I was like, yeah, I'm done. just done. I have some thoughts on that. I will probably expound either a written piece or at War Media's YouTube channel. But before we go any further, we do have a review. And on this podcast, we only accept 5-star reviews. And once again, we got a 5-star review. It works out quite nicely. This is from Northerner in the South. The headline is average. As far as average podcasts go, this one is very average and therefore best in class. Let me tell you something. We've gotten a lot of 5-star reviews, like 300 and something of them. That might be the most accurate one to date. So thank you for that, Northerner in the South. We appreciate it. Josh would appreciate it if he's here. Of course, we all know he shows up like once a year. So if I'm the Brett Favre, real quick before we get in the show, who is Josh? Who's the guy who doesn't show up very often?
That's a good question.
Is he like?
I don't know.
Yeah, he's like who's always getting hurt? I think about that because he is the guy who literally is always getting hurt. I would say like a Bo Jackson, but he's not that good. So
yeah, no, because I was going to go with Griffey, and then but same comment, you got to kind of like
right. You got to be good.
Yeah.
He's like, wait, okay. Here's the 50 most hurt athletes of all time. We have Greg Oden, and so Greg Oden, there's a lot of hype, but he never actually achieved anything. So that you have that.
You know, for those of you that were fans of the Killer Bees growing up in the 90s, the Houston Astros, Derek Bell, he was on one year and then terrible another year. I mean, he hit 210 and just couldn't hit the broadside of a barn one year, and the next year he puts together an all-star performance. I mean, maybe something like that.
To keep baseball, JD Drew. You know, when Josh thinks we have a viable sponsor coming up or a big guest, he shows up, he shows out, but most of the time he's pretty weak. Has a lot of off days. He's hurt a lot. As a Red Sox fan, we all can talk about that pain quite honestly. But JD Drew, he's not Grant Hill. He was never hyped to that level. I think those are good. Okay, so let's get into the actual show, what people were here for. Ben, the timing, as you said, is lovely because we have a story that you are probably an expert on. You're more an expert than I am. I'm not an expert at anything, as we know. This comes to us from Spectrum Local News. I hope that is not owned by the internet company. That would be weird. Anyways, Rule 37 allows Texas oil and gas companies to take residents' minerals without payments. Now, that headline sounds explosive. It sounds dangerous. It sounds like pure brand communism. Ben, you're in the mineral space. What's going on here?
Yeah, this is a really interesting issue. Like you mentioned, I have a close perspective on this. As a project that I worked earlier in my career, I was working for Arrington Oil and Gas, who was responsible for drilling up the city of Midland, and so was intimately familiar with this process. What Rule 37 says, Ryan, you're exactly right. It gives the oil and gas company right to drill the minerals in a certain unit, given some parameters, and then the parameters are important, but given some parameters without the consent of everyone in the unit. And so here's what this looks like in practice. And so, Ryan, if you own,
because we have folks from upstream, midstream, downstream, maybe break down what a unit is, just for those intimately familiar with the mineral space.
Absolutely. So, Ryan, let's say that you're a ranch owner and you own. We're going to make the math easy for this example. You own 1,280 acres of surface and minerals on your ranch, and XTO comes to you and says, "Hey, we want to drill some wells. Here's the lease proposal. Here's what we can pay you. Here's the contract." You go get it reviewed by an attorney, and you make the decision whether to sign or not. There's some negotiation, and then you either make the decision to go forward or not. Right? That's your decision. You have full right to do that. You own everything within the surface and the minerals there. There's no other parties involved. Now, in the city of Midland or one of these other cities, generally your home, I don't know what it's like out in Granbury. I think they're probably much larger lots. But in the city of Midland, as an example, the average town site home lot in a subdivision is somewhere between 0.161 acres and about 0.25 acres. Now, in Granbury area, what is it out there? Is it a little bit larger than that? Do you know?
Yeah, well, not in Granbury proper, but when you get outside, you can see definitely some larger lots.
So, in the context, going back to, Ryan, your ranch example, the 1,280 acres, but in Midland, as an example here, a mineral owner will only own 0.161 acres because you own the minerals under your home. Now, let's say, Ryan, that and I'm just going to make the math easy. Let's say that in a unit of 1,280 acres, which is what a unit is an area in which an oil and gas company has the rights to drill, that if they drill and produce oil from somewhere within those boundaries, they're able to maintain the leasehold of those within those boundaries as long as the production is continued. Now, let's say that in that 1,280 acres within the city, there are 2,000 mineral owners, and 1,960 of them have decided that they want to drill. They're okay with drilling. They've signed a lease. They want to move forward. The oil and gas company has given them terms that they are good with. They have signed their oil and gas lease, and there are 40 mineral owners sort of sprinkled within that unit, not contiguous, not next to each other, but just sort of randomly. Now, if those 40 mineral owners do not want to sign a lease, that's their full right to do that. They can make that decision. Again, going back to the ranch example, they can make the decision whether to sign or not. But the difference here is that there is a point at which the oil and gas company reaches a critical mass of that leasehold within the unit, so that the 40 mineral owners, you can make the case, should not be allowed to tell the other 1,960 that they're not able to make money from their minerals because the 40 don't want to sign a lease. Therefore, the company shouldn't be able to drill. Now, the resolution here is, to your point, the Rule 37 gives the oil and gas company the ability to drill if they cannot get everyone to sign a lease. But there is compensation due there. It's not purely they are without compensation. But sometimes if they cannot get to an agreement, they will be excluded from the unit. But the caveat here is that let's say that there was a pathway to drill that didn't go under the minerals or under the property of someone that didn't sign a lease. They would opt for that path because you can perforate, but just not under the specific location in which the lease was not signed or the mineral owner decided not to sign. Or let's say that logistically that's not possible, and so the drill path has to go through the minerals of an area that was not signed by a mineral owner. There's something called an NPZ, which is a non-perforation zone, which again is part of Rule 37, that if the mineral owner does not sign and there is no other drill path, the oil and gas company can get the authorization to continue the drill bit through that property, but they just won't perforate or frack within those boundaries. And so there's a lot more sort of context. That's a cat in the background there. There's a lot more sort of context behind this Rule 37, and there's a lot more optionality than maybe that article sort of paints out, or certainly that headline does.
Okay, so let's maybe unpack this a couple of perspectives. So one thing is in Texas, which is different than Louisiana. I'm not sure about Oklahoma, but in Texas, mineral rights could be owned forever, basically. In Louisiana, it's kind of harder to keep them. They revert back to the surface owner if they're not being used after 10 years. But anyways, so in Texas, and to use your analogy of this, inside the city limits, it's quite possible, if not maybe the case, that inside of a subdivision or a city, that the surface owners don't actually own the minerals, right? It's going to be a lot of people who have held on to these minerals for quite some time. So when you're talking about this, it's kind of a weird scenario. It's not like a pipeline going through where it's 1,900 people and they're all surface owners. Does that complicate the issue? Does it make it less complicated because you have this issue where you're like, okay, we got to drill, but these people could live in Kentucky?
It's fascinating. So you would think that, as an example, going back to my the previous example of Midland, Texas, given the oil and gas presence in Midland since the early 1920s, you would seem to follow that some homeowner in the past would have thought about reserving the mineral rights under the home. Now, I'll tell you, when I was on this acquisition project from 2014 to 2017, give or take, in those years, over 90% of the current homeowners also own their minerals. The minerals had not been settled, which I found was a really interesting trend. And if you talk about maybe areas that are not as that oil and gas is not as prevalent, I think that divide would be even greater. And so there wasn't as much of that, but there were, I had conversations with people that, that we were sitting at the kitchen table and they're asking me, okay, so what happens if, you guys start to drill and oil is coming out of the backyard?
Right.
And my response is, then you're Jed Clampett. That's a really good problem to have. Right. I mean, this is,
right.
That doesn't sound good, but we're also talking about 2 miles underground, and you could be, and one of the things I used to tell people is, you could be standing in the front yard looking at the ground as the drill bit was going under the property, and you'd have no idea. And so that was kind of an education process, because again, going back to in Midland, you think about, you're going to drill a well, and you think about that being like out in that random branch. You don't think about it going under the city. And so there's some concerns there, but at the end of the day, it becomes a critical mass so that the project is going to move forward, whether there's an entire buy-in. And you also see that in more urban areas. It's not exclusive to,
sure,
inner Midland or inner city units.
Yeah. So on the show, we quite often talk about, the industry has to protect the impacted owner. I don't know how you get around eminent domain and expropriation. At the same time, I'm always reluctant to say that we should have it. It's one of those things, because if you're not careful, they just start taking everything. This is basically what's happening in this case. Is an eminent domain, more or less, when you're pulling the units, because you're forcing someone. No, disagree. Go ahead.
Yeah, no, I definitely disagree, because the kicker here is that the optionality, or the restriction of that optionality, is only once the oil and gas company, which is a private entity, has voluntarily, or has gotten enough of the mineral owners within a unit to voluntarily sign a lease, so that the remaining are given an option. Again, they're given an option of to get paid and to remain in the unit, or to be excluded. There is never a scenario. I mean, it doesn't exist where there's a scenario that the oil and gas company drills the mineral owners' minerals under their property within a unit, even with or without Rule 37, where the mineral owner has not authorized that. If the mineral owner doesn't authorize the drilling, they will be either, like I said before, they will be either non-perfed, or they will be excluded from the unit altogether and not drilled, or not drilled under. And so in neither one of those scenarios, they're not actually being damaged.
Okay, I misunderstood that point. Okay, so what you're saying is that unlike a pipeline where eventually they will build across your property. Here, they would not take the minerals.
I mean, the drill bit has the ability to go, in an S. It can go around a property.
Okay.
Now you can't like snake it all the way through. You can do that sort of sparingly. And if you it's just like any other kickoff point. If you kick off, you have to maintain that, that lateral, but you can kick off around a property or a section. So let's say let's say there was a landowner or a mineral owner that owned a city block within a city that didn't want to be drilled around. You would be able to kick around that. And so they're not actually being damaged. Now you obviously have drainage, etc. But
Sure.
but again, that's just part of the.
So let's talk about it from the landowner's perspective. If they're sitting there, there's a block of 2,000 units, and they're wanting to hold out, and they think the price is too cheap. All these other people are suckers. The price is too cheap. They want to hold out. Would you advise them to hold out? Because it would seem to me that if they hold out, maybe later on, if you start drilling that it's too late, they might get a worse deal. Is the deal locked in once everyone's assigned? And this is not obviously official advice for people listening. It's just general how to think about it, because we do have landowners who listen to the podcast as well, and I don't know how to think about it if you're the landowner, because I could see them going, God, the price is too low. Like, I know the business, you don't, in a non-oil and gas area, but everyone else has fell for it, and so should they hold out or not?
Yeah, absolutely. Yeah. So it's very much a double-edged sword. So what I'll tell you is, in the genesis of the project that I was on when I first started, it was very much an idea. It wasn't clear that we would get enough leasehold to make this work. It wasn't clear that we would get enough traction to actually be able to drill. And so because of that, we were paying very, very little in terms of bonus and royalty, and the terms were pretty favorable to the company. So when the oil veterans were being approached by those numbers, general response from that was, come back to me when this is real, or this isn't enough, but like let's circle back. And so then over the lifetime of the project, when we got to a point where understood that this was going to happen, but now it's about putting together a unit, obviously the price exponentially increased. And so then we had a lot more traction from sort of the oil experts. What I would tell you is, if I were in a situation like that, if I had owned minerals within this, and I was being approached with that sort of conversation, I might look at opting to participate in the unit as a either non-consent royalty owner, or try to get something on the working interest side of the ledger. If the other piece of this is, if you're talking about you're owning 0.161, or use easy math, a quarter acre within a 1,280 acre unit, that means that you own nearly 1/5,000th of the unit. And so we're talking about infinitesimal revenue, sort of regardless. And so, if it gets to the point where it's going to happen, I would advocate for get as large of a signing bonus as you possibly can. And then, the royalties are going to be, they're going to add up, but they're not going to, they're going to maybe pay the boat payment. They certainly won't pay for the boat.
Okay. One other question real quick on the royalty stuff in general. I don't know if I've ever asked you this offline. So I'll ask you online, because that's always appropriate. Is there a certain size of mineral acreage holding position that you should have? Sorry, let me rephrase it. At what size of, if you have, is it 10 acres, 20 acres, 1,000 acres of minerals? When you hold that, should you consider hiring out a landman to represent you? Because to your point, if you have a very, very fractional percentage, it's not, you're probably going to lose money by bringing somebody in. At what point is there kind of a threshold to go? Is it 10 acres, 100 acres, 1,000 acres, where you need to bring in a professional to represent you?
I don't know if it's as much as of an acreage count as much as it is what's the activity like, and sort of what does that fractional ownership look like, and so if you own a number of small interests, but they happen to be in a number of different places where you are getting offer letters and lease offers left and right continuously, and it's enough of a volume that you need someone to support that, I would look at hiring someone out, and that might be more on a contract basis. On the other side of the coin, simply if there's enough revenue being generated from the minerals that it would justify hiring someone to manage those. Because I think one of the things that is sort of lost in translation with a landman managing minerals, a lot of times that's sort of looked at as like a sunk cost or just sort of a loss leader on the ledger. Whereas what the landman, if they're doing their job correctly in that scenario, is they are actively in conversation with the operators around you, making sure that they're on top of current terms, current operations, current landscape, et cetera, to be able to advise whether maybe you're in a situation to add minerals to your portfolio if it makes sense, or maybe it's the right time to sell minerals. There's sort of been this ethos for a long time, I think, in the mineral owner world that never sell your minerals, and I we can talk about that or not, but I'm very much on the other side of that coin. I think there's lots of reasons and lots of times that you should, and so I think a mineral manager or a landman in that scenario is much more of managing the asset and trying to grow as opposed to just sitting there and sort of being more passive. Does that make sense?
Yeah. That's helpful. Okay, let's move on to a couple of things before we have on our guest, Mark Rossano. You're out in Midland, as you mentioned, Texas. This is from the Center Square. Texas upstream oil and gas sector continues to add jobs. This has been something we talked about on the show a couple of times now. It doesn't feel, despite the price being, I haven't looked at this morning. I saw OPEC just cancel their meeting, so I'm curious what Mark has to say. It doesn't feel like the industry's back at $70 oil. We're at 75 right now, WTI. It doesn't feel that way, at least following the news and what's happening. In Midland, does it feel like we're at $75 oil? Or does it feel like we're still working to get there? Because we're getting jobs back. The rig count's kind of floundering around. What's your read on it?
Yeah, out in Midland, it's the engine's revving out here. Absolutely. I mean, things are blowing and going. The rig yards are a lot more sparse than they've been in any of the recent months. All indicators are that people are getting out to work. You see pipeline crews everywhere, wireline crews. I mean, it's a good sight when you drive around. For a while, it was pretty quiet out here, and there was a lot of heart. But no, as of recent, there's a lot of positive things going on out here.
Yeah, so I talked to a couple of vendors, and they were saying that that they're really struggling because despite and that may be where they're positioned at, but despite the price going up, that there's just not enough work to really kind of get them going again. So it's interesting to hear that you kind of, your vibe is that things are really what.
I think on that, Ryan, I think I consider the source, and what I mean by that is that the firms that have too much fluff on the balance sheet and are not running efficiently, they're never going to make money in the oil and gas business, whether it's 75 or 100 or 40 or it doesn't matter. But I think that in the last 15 months, the firms that took that opportunity to streamline operations, become more efficient, become more effective, I think there are a lot of groups that are making a lot of money. But yeah, if the incentives are misaligned, or if you're sort of SOP and you just sort of took 2020 as a gap year and you're trying to rev the engine back as just like you ran it in 2017, 2018, I think that we've seen that recipe fail miserably time and time again. And anyone that's trying to go back to that is going to see that same experiment.
Well, the real question, I think the indicator is Shack in the back to full pre-pandemic levels.
Shack in the back is bustling like it's never bustled before.
Really?
That place is like a paradise oasis in the desert. They've turned that thing around. It's green. It doesn't even look like it's in Midland. But no, for those that had not been out there, check it out. It's something else. I think they took some stimmy money and put it to good use.
And you're out there doing your thing, 3-4 times a week? Shack in the back.
I've been out here for I've been out in Midland for 7 years full time. I've been to Shack in the Back, I think 4 times total. So I'll let my record speak for myself.
Yeah, like I said, 4 times a week. Okay, yeah, good. Okay, let's see here. I think one more story before Mr. Rossano hops on. This is from June 30th, so just a few days ago. Chevron to sell swath of Permian assets valued at more than $1 billion. On this show, we have made a point thinking that for years now that the consolidation to the majors would happen. Now with ESG and kind of the pressure that you're seeing, maybe we're going to be wrong on that, and it's going to be a decentralized Permian Basin if the majors start selling off assets. What's kind of your read on this, Ben? Do you think that the majors are going to stay out in the Permian, or are we going to start to see this slow, steady sell-off? Is this more virtue signaling, or is it a real concern?
I think it's interesting. I think that there's sort of a conversation around. So on one side, if you're, to your point earlier, I believe last week you had a guest on, David Blackman, that was talking, and actually that might have been on Inside the War Room. Now that I'm speaking about that, but he was talking about $150, $200 oil. If you believe that thesis, or if you believe anywhere sort of near that upside trajectory, I think there's a strong argument to go out, as an investor or as a principal on one side of the ledger or other, go out and buy production, go out and buy leasehold, go out and begin operations. Because if you can become operational in this environment, and we're going to see that sort of ramp up, I mean, you're just sort of printing money. I think on the other side of the ledger, the Chevrons of the world have the ability and have the seat so that they can decide temporarily or permanently, but temporarily, to leave the more sort of hotbed issue in terms onto the geopolitical side in the Permian and go offshore. Because Chevron has made a number of announcements in the last 6 months about some major offshore opportunities and exploration discoveries. And so are they just simply going to be going back to just like what happened in the 80s? Are they going to go back to focusing on the offshore and international portfolio and wait for the domestic market here in the U.S. to calm down, or to sort of realign and be more inviting for that development? I think you're.
Go ahead.
Last thing I was going to say, I think you saw the same thing with Shell. I mean, Shell's been talking about the same thing, and I think you've seen a number of the majors sort of kind of point at the same issue. So
if you have the majors on some level moving out, we've heard about the struggle to get funds to these operators in West Texas, especially. How does that play itself out? Because the majors, the publicly traded companies, their ability to raise capital is a little bit different than the privately held companies, and I know there's a big debate over which is actually a better avenue. What are your thoughts on that? Do you have a strong opinion on who might be able to raise capital in the future better than the oil and gas space, a privately held company or a publicly held company?
I'll answer it. I don't know if this is an answer to your question, Ryan, but the companies that are going to be able to raise money in the future, and drum roll, please, and this is irrespective of private or public, but it's the ones that are focused on driving profit to the company, not adding acreage to the balance, or adding acreage to the pitch deck, or adding these other metrics. It's going to be about the companies that are running efficient operations, that are driving profit to the bottom line, and aren't paying their C-suites ridiculous numbers when the production is garbage. If you see that alignment, you'll get better answers to what you're talking about here. You'll have a lot more liquidity available in the market.
Well, if someone wants to pay me a crazy amount to be on the balance sheet, then I'll take that. Okay, let's see here. We have our guest on now. Let's see. Let me get him on up here on the big screen. Well, how about this trifecta deal? This is kind of wigging me out. Here we go. The man himself, Mark.
How's everything going?
Good. Mark, how you doing?
Good. Happy 4th.
Yes, very much so. Now, you've been on Inside the War Room a few times, but your first time on Texas Oil and Gas Podcast. So maybe a quick introduction of who you are and why people call you the Wizard.
So I run a consulting company and a private equity firm where we invest in energy infrastructure, and on the consulting side do macroeconomics, energy, pretty much across the board. And then we also launched a YouTube channel where we discuss macroeconomics, geopolitics, and energy pretty much across the board, 3 days a week. And then on the primary vision side, we have the U.S. Frac Spread count, where we look at all of the activity in the lower 48.
Yep, and the Frac Spread is part of the reason we want to get you on. We'll talk about the OPEC and the international stuff as well. But let's start with the Frac Spread count. What does that actually mean for people who are new to the term? Sure. You see it everywhere now, but what does it mean? Where are we at as far as a year ago, and then where are we at compared to where you thought we might be from a year ago?
Sure. So the Frac Spread count is so when you drill a well, the well will sit there until the Frac Spread crew comes up. And a spread is just the horsepower that comes in to actually fracture the well and bring it on to production. So we're much closer to the actual production number in the U.S. with about a 90 to 92% correlation over the course of 30 to 60 days. So our expectation coming into the year was that we were going to hit about 250 spreads, and we've actually taken that a bit higher to peaking at about 275. So each spread is just one crew that comes up and will complete 1 or 2 wells at a time, depending on the type of technology that's being used on a simul-frac or just a regular frac job. So we actually took that higher. As of I think 2020 was we were still in key chaos at about 115 spreads, and right now we're at about 234. So our view is that we're going to get to about 275 by the time we get to the end of July, beginning of August. And the other side of the equation that we have to talk about, because everyone looks at this and says, well, we were at 445 at any given time. And the problem is, right now we have a lot of oil spreads. So gas is being ignored. The focus is oil, obviously the Permian. We're actually over the Permian. When you look at 2017 versus 2021, the Permian has 123 active spreads moving throughout. And the whole focus when we came into 2021, on our view, was that they were going to bring back crews quickly, try to stem the tide, because we saw those declines from 13.2 to about, let's call it 10.8, and was to kind of walk themselves back up before they started focusing on drilling wells again, bringing rigs back. So we thought it was going to be very heavy to the frac spread side. And then as we got into Q3, rigs were going to start to increase and crews were going to continue to increase, but just not at the same pace, because right now we're at this nice running room to give us an exit ratio of about 11.5 to 11.7 million barrels a day.
Okay. So we were talking before about the price. I think right now it's at 75. I know we had you on Inside the War Room a few weeks ago. Maybe quickly summarize your thesis on the price for those who aren't familiar with it.
Sure. So on the price side, when we're doing our analysis for clients on the EIA show, we look at the whole. We look at energy as one, essentially flat line. We look at it on the full supply chain and what we call well to wheel. So we're looking at this from oil, hydrocarbons out of the ground into the OFS midstream, and then we're looking at refiners, end users, whether it's refiners, petchem, because we want to look at where is there oversupply, where is there shortage. So right now everybody loves to talk about oil draws and oil going down, but then they ignore the fact that jet fuel and gasoline, if we take out 2020, is at all-time highs. We keep having refined products building in Singapore, ARA when you look at Europe, then when you look at Fujairah, and there's almost 8 million barrels of disti that just can't, or I should say distillate or diesel, that can't find a home. So when we look at this, we're looking at it not just from the oil side, but also from the refined product side. So our view is that there is a remaining oversupply in the market. When you look at oil, it's the summer, we normally draw down, but we also typically draw down refined products, and we're just not seeing that in the same way, which gives us a pause. The US dollar, because everybody loved to talk about the US dollar when it was going down and why you bought oil. Well, now oil and the US dollar actually have a positive correlation. So that thesis is thrown out the window. And obviously, we have our favorite, the OPEC meeting to cause some chaos.
Okay, one more question. I want Ben to hop in here. I just want to set the table for the kind of topic talking points. Is OPEC? OPEC, I guess they saw that we had the podcast, so they decided not to break news while we're recording, and they have indefinitely suspended OPEC meetings. First off, break down what happened over the past few days, and what do we make of this news of this suspension of meetings without a date to be to continue talks?
Sure. So when we look at OPEC, you have to each entity within OPEC has their own reasons to be there, and then obviously for the group. So we made a call back in December of 2020 that the UAE, or the United Arab Emirates, was going to become a big problem, because if you remember, they quote unquote cheated. Saudi Arabia called them out. They said, "Hey guys, you can't do that. What are you doing? This is ridiculous." But when you look at Russia, Iraq, Nigeria, everybody's cheated. It's just essentially they just wag the finger, try to embarrass you. And as we know about Russia, the Russians can't be embarrassed. They don't care. Say whatever you want. Iraq and Nigeria have a balance sheet problem, so say whatever you will. They're just going to do what they need to do. So when you look at the UAE, they had something to lose because they're the biggest. I mean, obviously with the GCC, the Gulf Cooperation Council, they were a big part of that. They were with Saudi Arabia when we look at the fight in Yemen. So this is a big political issue, not just a oil and gas issue. So when you look at what happened, they decided to use the baseline when the OPEC cuts were agreed upon in April of 2018. And when you look at what that was, Russia and Saudi Arabia were actually increasing production where the UAE was bringing production down. So the baseline that they agreed to for the UAE was at 3.1 million barrels a day, not their normal 3.8. So their whole thing is, look, it's unfair. We've had to cut more on a percentage basis than anyone else. So you need to restrike us at a baseline that makes sense, essentially admitting that they made a bad deal. They're already exporting about 150,000 barrels above their target. And we always think of exports as kind of a better baseline to figure out how does that impact the market. And instead, the UAE saying, look, we're not going to come to an agreement unless we can normalize our baseline. And Saudi Arabia and Russia are like, no, this can't happen. We need to do this in a controlled fashion. And the UAE is essentially saying it can still be a controlled fashion, but we're not extending the deal because the deal was supposed to expire in April. They wanted to push it to December. The UAE and Mexico said, absolutely not. It's going to end in April. And then on the baseline side, the UAE wants to increase. And it's not that they're going to produce 3.8. They want the cuts to be based off of 3.8. So when they walk back the cuts, it's not from 3.1 to 2.7. It's at 3.8 to about 3.3, 3.4.
Ben?
So
you're muted. Go ahead.
No, Mark, I appreciate that. That's some really interesting context there. So I'm curious, from that, I mean, what's the signal? What's the takeaway from the suspension of the meeting? I mean, is this sort of just SOP and we're going to kick the can because we don't want to get to the table, or do you think that this is somewhat maybe more nefarious or aggressive in the sense of sort of a signal that those parties that you're talking about are going to be more self-serving in their interests here in the interim until they can get back to the table whenever they reset the meeting?
I think it's a mixture of both, and I think you bring up a good point with the self-serving side, because when you look at the UAE, they've been investing on oil expansion. They've been investing in their fields. They've been looking to expand production. And when you look at what they've decided, so typically the Middle East has what's called a destination clause, which just means that the company that buys it has to enter that company and their holdings. So if Saudi Arabia were to sell it to Exxon, it's going to Exxon and it's going to Houston. It's not going to Exxon and then being sold to Shell and then being sold to CNOOC and then ending up somewhere in the Southeast China. So when you look at destination clauses, this is good because typically they won't have different cargoes competing against each other. Now, the UAE launched the Murbain futures because they wanted to be the benchmark, and they got rid of destination clauses, which just said, "Hey guys, if you buy these futures, we're gonna settle these in the physical, and then you can take them wherever you want, and you can resell them the moment they push off." And this was a big break that we were talking about because we thought this was a bigger shakeup than what the market was actually coming back to. So then you look at politics. The Yemen war was expensive. The UAE was looking to exit it or come to some sort of an agreement way before Saudi Arabia was. And there was also that pushback in the Saudi Arabia and the UAE. Some of their individuals within that, or some of the groups within Yemen were actually fighting each other and not against the Houthis. So there was also that weird thing that was dynamic that the market kind of forgot about because it was in 2020 and everybody wanted to just purge 2020 from their minds. But there is a lot on a political sense. And then when you look at the UAE, they're like, look, we've taken the biggest hit. Everyone's balance sheets are stressed. We know that. Now we actually have the opportunity to make it back. The price is convenient, so why are we going to sit back and wait?
Yeah, so let's talk about that benchmark thing, because I remember the story coming out last year, and there was a little bit of debate about it. It's like it kind of died off, and so it's funny to hear that that's coming back into the discussion at this point, because it didn't feel like it got the coverage it deserved.
Right. And it's the grade too, because if you think about where we are in crude quality and the kind of crude that is being demanded, when you look at what they're putting out into the ocean, I mean, this is something that is going to be demanded by Asia. When you look at the Dubai spreads versus Brent versus WTI versus West Africa, they've essentially just been flooding the market with additional barrels, which has pushed the Dubai benchmark lower, which just means that if you're in Asia, India, China, you're going to have more of a propensity to purchase from Dubai and things off of the Dubai benchmark versus West Africa, which is Angola, Nigeria, which we've seen those cargoes struggle when we look at Brent and how those spreads are going down. And then in WTI, where we've actually had the reverse. So there's a big issue, because when you asked about why I think there's some concerns going forward on crude price, well, you just have to look at the physical market. Everyone's talking about spreads now because guys are getting good with spreads. But when you look at the actual physical spot market and the future spot market, because this is an important component, you can actually see that they're being left on the water, and we keep having deferrals, especially out of Angola and Nigeria. And that it's just showing some weakness on very specific grades, especially ones that are, can essentially go into anything, which we like to call the Goldilocks crude.
Let's talk about China for a second. China was buying a lot of oil. Q3, Q4, I think last year, it slowed down Q1. That helped keep the prices up. Some people speculate that when that slowed down, the prices might drop. There's always talk in the U.S. about what to do about China, and one of the things that we should say is sell them our oil. What's going on with China buying oil? Are they still buying as much oil? Have they slowed down? Are they putting the oil that they bought last year back into the market? What's your read on that situation?
So they have slowed down in a pretty sizable way, and when you look at what does that mean? So it's China. So let's just say that the numbers are a bit fuzzy coming out. But there's an estimate that there's about 1.3 billion barrels of storage available within China. As we came into January, they had a little over a billion. It was about a 1.017 billion. And before pre-COVID times, the before times, they had about 860 million, and they're currently sitting at about 974. So they're still well over where they were. And they're trying to work some of that off. But now this gets complicated because they've also sanctioned the teapots, which are just the independent refiners, for lying, not doing what they're supposed to do. So they've actually cut their import quota by 35%. Now, that doesn't mean that they're going to see their crude imports decline by 35%, because the SOEs, or the state-owned facilities, they're coming back into operation, and this just paves the way for them to make up for what the independents aren't doing. Now, on the other side, they've also increased the levies on what's called, short cycle oil, or semi-refined oil, that can no longer come in, or at least it's not economic to come into the country, which is going to impact South Korea, Japan, Singapore, and then Malaysia at a smaller way, just in terms of the way crude is going to shift. So they're really coming after some of this oversupply, and are trying to readjust by protecting the SOEs and impacting the private side and the independent refiners to make way, because there is still another about 1.2 million barrels a day of throughput slated to come on over the next 2 years that are state-owned.
So, Mark, I'm curious, sort of when you couple what China did last year in the ramp up of buying up crude, either from a market arbitrage perspective or simply just, to bank the resource. And now in 2021, you've seen them, to your point, throttle back on the crude buying, but really press the throttle down on soybeans, wheat, corn, some of these other commodities. I think it's sort of the same story, but just a different resource to a degree. I'm curious if you have any comment on sort of the bifurcation between those two, because as we continue domestically and globally to read about droughts and food shortages, if China is going to continue to be a major buyer in those soybean and wheat markets, I think you're sort of seeing a similar trajectory. Do you agree with that pathway? And any comment there?
Sure. So when you look at China, China has about 12% of the world's arable land, but 22% of the world's population. They've had a yield that peaked in about 2014. And if you look at the purchases, they went after and bought Monsanto. They have tried to come up with deals to create their own seeds and their own fertilizers. The problem is they've essentially run to the fullest of their extent based on where people live. Because when you look at it's called the 12-inch line, and the 12-inch line is typically you need more than 12 inches to have arable land. And when you look at the country, a lot of as you go east and look at the coast, that's where those 12 inches exist. But the problem is about 80% of their population also lives there. So you're looking at where a lot of the arable land exists mixed with the population. So they've already had an issue when you look at the farmland. Now, taking to what you've talked about, last year they started to have these big issues where they had these pockets or these micro droughts, which just essentially moved out all around. And then you had these massive floods that created the Yangtze River Basin essentially getting decimated, killing about 98% of livestock and almost 100% of grains that utilize that basin. So they came into this year with a massive shortfall. Then they also had army worm, which destroyed some of their corn crops. And then we obviously know about swine flu and bird flu, which have decimated a large part of their livestock. So they're coming into this market very short. Now, you talked about those droughts. They've essentially through 2008 to about 2018, they were very active in Brazil. They brought them into the Belt and Road Initiative. They built out roads. They built out ports. They tried to increase the efficiency, because Brazil actually loses a lot of its grains to rot on its way to port. So now what do you have? You have massive droughts in Brazil, which are impacting yield, but it's also impacting the logistics, because as you don't have water, the rivers fall, and then as the rivers fall, then you can't put as much on, and that becomes a much bigger issue. So all of this is shifting them into the U.S. and relying on the U.S. on a greater scale. And just because of how long this takes to replenish, they're essentially beholden to the broader market, and they haven't been able to catch up. And especially if you look at 100 years of the CCP, we've eradicated the poor. We've essentially pulled everyone out of the dregs of society in terms of giving them a living wage, giving them a livable capacity. Now, that's almost near impossible to say unless you can feed these individuals, which is why there's a big reason to continue to do that.
Okay, so let's bring this all back to where we started, which was the frac spread, the textile and gas industry. How do all these things impact the textile and gas industry moving forward? There's a lot of complex topics that you spend a lot of time following, and we want to make sure we plug that after this comment here. But what should we be thinking right here as we're July 5th, 2021? How do we feel about the industry, the strength of the industry? Obviously, we have internal pressures with capital, the ability to raise money, the ESG stuff, but you have these external factors that have nothing to do with us. Do we feel like we're in a good spot right now? Are you concerned about the oil and gas industry? And for those who are listening, how should they make their plans as they move forward through 2021? Should they be a little bit more cautious? Should they try to go all in? What are your thoughts?
So from the producer side, I would say that right now it's a good place to start laying on some puts, just because we've seen a very strong rally. We have the curve is shifted up along with it, so you can hedge well into 2023 at a very profitable number. When you look at the U.S. in general, I'm actually more bullish on the liquid side. So when we look at condensate or naphtha and NGLs, that's where I've always seen a large growth. And as you talk about with ESG needs a lot of plastic, and the U.S. produces a lot of products that is very good at making plastic. So when we look at oil versus the liquids, I actually think the liquids is going to continue to see a lot of favor. And then when you look at thermal coal pricing, and coming back to China, when you talk about those droughts, well, the droughts are also hitting when you think about, well, power gen. How much of that is hydro, and then what is the hydro backed up with? And if you can't use hydro, well, you're going to use thermal coal to, and then if you can't use thermal coal, or if you don't want to, it's LNG. And what does the U.S. have a lot of? We have a lot of natural gas. So there's a lot of reasons why we're going to continue to see some strength. And when we think about the U.S. producing at 13.5 million, 13.2 million, we killed our internal market and our external market. So, but at 11.5, 11.7, it's a very comfortable market where the U.S. can not only just use a lot of some of that light sweet crude to make product at the refiner side, because they've also been building out the lighter end of refining, but it also opens up our ability to export more into Asia and Europe. And now, even though COVID is behind us, or at least we like to hope so in the U.S., it isn't in other places. And when you think about that, that means refiners just aren't operating. If they're not operating, there's a shortage of naphtha, there's a shortage of LPG, which allows the U.S. to backfill that. So there's a lot of reasons why we're going to see some stickiness in terms of activity in the U.S. on not only just the oil and liquid side, but also on the natural gas side.
Okay, Mark, tell folks where they can find you. You mentioned you have some shows. Obviously, you come on this fantastic podcast, Inside the War Room, and give out this stunning insights with the host there. You and him are just two peas of pot. No, seriously, you have the EIA show, you have
the economy show, geopolitics, and then the Frac Spread show.
And that's on the Primary Vision YouTube channel?
Yeah, the Primary Vision Network is the name, PVN, and the EIA show goes live on Wednesday. Econ and geopolitical show goes on Thursday, and then the Frac Spread show, where we give these numbers and then some of this data that we've talked about, on Friday, and then we do a quick recap on the macroeconomic backdrop, just to take you into the weekend with some nice nuggets of information to be interesting at parties.
Okay, and then you also have reports and stuff I think you guys sell. Where can people contact you for that information?
Yeah, you can pvmic.com. We put out about 4 reports a year looking at the supply side. So as we talked about with the Frac Spread, a Frac Spread count has horsepower. So we look at all the horsepower broken down by basin, by producer, just to look at who's operating where. And then we always link that. So we have every spread connected to the OFS that owns it, and the EMP that is operating it, or who it's operating for, and what basin. So we provide a broad backdrop. And then we give you how much horsepower is available, which just means how many spreads are there. Are they cold stacked, warm stacked? What's the likelihood they're going to come back? And then we try to layer that in with what is happening in the geopolitical world, because we are exporting right now about 3.3 million barrels a day of crude. And if, for those who don't think that's important, well, just imagine if that stopped and 3.3 million barrels gets pushed back into our storage per day, per week.
Okay. We will link to all that in the show notes. Mark, appreciate you coming in on this holiday Monday. You are a red-blooded, true blue American, even though you are a Yankee, but it's okay. We can't.
I tried. I had my colors on.
You did. Well, enjoy the rest of your holiday, brother, and we'll talk soon.
You too, guys. Thank you for having me.
Thanks, buddy. All right, Mr. Samuels, let's go ahead and land this bird. Or if you reach out to Mark, be sure to tell him that you appreciate him coming on this podcast. Always let the guests know. It's good to let the folks know that you heard him here. Mr. Samuels, any final comments before we get out of here today?
No, you were in rare form today. I appreciate that. It's a different Ryan than I usually get on the other couple shows. So this was good. I appreciate you having me on. Hopefully I made you look good.
Yeah, hopefully. Okay, listeners, thank you so much for tuning in. Be sure to check out all of stuff Ben's got going on. He is one of the listeners on our other podcast, dubbed him the Oracle of Midland. So be sure to check him out, Source Rock Midstream, and all they have going on. And until next time, keep climbing.